Okay. So we continue our talking point with a discussion of expenditures during an asset's useful life. So we want to separate those into two categories. Ordinary repairs. These are things that maintain the functional operation of a vehicle. Oil changes, um, you know, lubricating bearings and um, you know, just maintaining things, changing air filters, things of that nature. Those are ordinary expenditures. They do not increase. They're not capital expenditures. They would go to the expense to the income statement during the period in which they were incurred as like a repair and maintenance expense. All right. These are things that maintain the proper function of an asset, but they don't extend its useful life. They don't expand its capacity to make it more efficient. All right. So those types of expenditures are expensive. All right. Oil and stuff like that. Putting new all right, we generally do an ordinary repair. Um, and we separate those from additions or improvements. These are expenditures that add to or make an asset better. So they can make it more efficient, more productive, or last longer. From the standpoint of the vehicle, this would be adding a new transmission. This would be overhauling the engine. Um, those types of things. From the standpoint of the building, doing a new wing onto it, adding a high efficiency uh, HVAC unit, so heating, ventilation, and air conditioning unit. Those types of things are capital expenditures. Also, expanding, building a new wing on the building would also be a capital expenditure. They increase the asset account and would be depreciated over the asset's remaining useful life. All right. Whereas revenue expenditures are expense in the period in which they're incurred.
Alright, so next up we're going to talk through plant asset disposals. That is getting rid of plant assets. Alright, we'll talk about two methods. There are three. The third is exchange. It's covered in the appendix. I won't test on that. I won't hold you responsible for it. But if you are interested in that, please feel free to take a look. And if you have any questions on that, I'll be sure to address them. So the types of plant asset disposals that we're going to be responsible for is the sale of a plant asset, that is, sale of a used asset, and for cash, all right, and retirement, all right. Whether you're selling an asset or retiring an asset, and retirement just means scrap. The asset is scrapped. It means that the company doesn't make any money on the disposal. They're not selling it to a third party. They're just getting rid of it. Okay. So the whether you're selling or retiring, you depreciate up to the date of disposal. All right. So that's going to be your first step in your plant asset disposals. If you make sure that depreciation has been reported up to the date. If it hasn't, you're going to need to do that before you can properly dispose of the plant asset. Once you do that, there are going to be two accounts related to each asset. The first is the asset account. If it were this truck that you see on the screen, it would be equipment, and then an accumulated depreciation related to that specific asset. All right, so you would zero both of those out. In a way, it would kind of look like the closing process. So the accumulated depreciation has a normal credit balance. So you debit accumulated depreciation in an amount that zeroes the account out. And the asset account would have a normal debit balance. And you would credit that account in an amount that zeroes that out. and then you can have a gain or loss, right? And if there's a sale, you will also have debit to cash. All right, let's take a look at this in action. All right, so we're going to look at E9-9, which is illustrating the disposal of plant assets. All right, so the instructions: journalize all entries required on the above dates, including entries to update depreciation where applicable on assets disposed of. Ridge Company uses straight line depreciation. Assume it is up to date as of December 31st, 2014. Alright, January 1st. Retired a piece of machinery that was purchased on January 1st, 2005. The machine cost $62,000 on that date and had a useful life of 10 years with no salvage value. Alright, so from January 1st, 2015, January 1st, 2005 to January 1st, 2015, that's 10 years. The asset would have been completely depreciated and there was no salvage value. In other words, and we have equipment and accumulated depreciation. Alright, so the equipment initially cost $62,000 and it's fully depreciated, and since there was no salvage value, $62,000 would have been depreciated over the 10 years. So this is how the accounts look as it relates to that asset. So to write it off, we just reverse these out. So our debit is going to be to accumulated depreciation, credit to equipment, alright, so that's all we need in the first entry, and that would be, January 1st. Alright. On June 30th, sold a computer that was purchased on January 1st, 2012. The computer cost $45,000 and had a useful life of 5 years with no salvage value. Alright. So the last depreciation on this entry would have been recorded on December 31st, 2014. So we need to calculate annual depreciation and depreciate from January up to the end of June, or half a year. Alright, but we need to calculate the straight line approach. So let's do that. We've got $45,000 is purchase price. No salvage value, so we can take that and divide by 5 years. and then take multiply that by 6/12, all right, which gives you depreciation for that year. And so why don't we just do that. Alright, so we get $4,500 depreciation for the year. We'll bring depreciation current up through that date. Alright, so we brought depreciation current, which is the first step if it is not current. Now we need to record the disposal. Alright, in this case, we'll take a look at the T accounts. We've got equipment, depreciation. Alright, so the equipment's going to have $45,000 in it. Accumulated depreciation. Well, we need to calculate depreciation prior to the year 2015. Alright, so from 2012 to 2000, for the year 2012 and 2013 and 2014. So we get accumulated depreciation of $9,000 a year, because we had $4,500 for half a year. So accumulated depreciation is going to be equal to $9,000 a year. It's been depreciated for 3 years up to this point, and 3.5 years. So we'll have 9,000 in year 1, 9,000 in year 2, 9,000 in year 3, and then the 4,500. Which adds up to, undo that highlighting. $31,500. So that's what needs to come off the book. Equipment for $45,000 and accumulated depreciation for $31,500. All right. Sold for $14,000 cash. That's easy because it tells you sold for $14,000. Accumulated depreciation on this piece of equipment, and keep in mind for this particular problem, each problem is considered independently. Right. So accumulated depreciation comes off the book. We debited, that would zero this account out. Equipment comes off the book for $45,000. We credit it. For $45,000. Now at this point, debits don't equal credits in this instance. Right? And when that happens, we have to plug somewhere, and we have the gain or loss, which can be if we have to credit, as is the case in this problem, we credit, and that's a gain. If we need more debits, then we would debit, and that would be a loss. Right? So the debits up to this point add up to $45,500. So we need 500 more dollars worth of credits to make this entry balance, and we'll label that gain on sale of equipment. All right.
All right, and for our last December 31st entry, we have it says discarded delivery truck that was purchased on January 1st, 2011. The truck cost $33,000 and was depreciated on the basis of a 6-year useful life with $3,000 salvage value. Okay, so the first step is the computation of depreciation, annual depreciation expense under the straight line method. So that's going to be the $33,000 plus the $3,000, and it's a 6-year asset. So we'll divide that by 6. All right, it works out to $5,000. All right. So that's our first step, is because this asset wouldn't have been, the last depreciation that was reported was in December 31st, 2014. We're now at December 31st, 2015. So we need a full year worth of depreciation. And it records that with debit depreciation expense. And we'll credit accumulated depreciation. Alright? So that's the first step, depreciation up through the date of disposal. Let's take a look at the account that we need to get rid of to actually dispose of the asset. Alright, so equipment, that is going to be still reflected as historical cost of $33,000. Accumulated depreciation, well, from the beginning of January 1st, 2011 through the end of December 31st, 2015, 5 years, annual depreciation is $5,000. So our accumulated depreciation is going to be 5 times the $5,000, or $25,000 bucks. All right, so these are the accounts that need to come off the book, and so this accumulated depreciation has a credit balance, so we'll need to debit it to zero it out. Equipment has a debit balance, so it needs to be credited. $33,000. All right. At this point, it doesn't balance. This entry doesn't balance, so we need more. It looks like we need more debits. We need debits to make this entry balance. Loss on disposal. We plug the difference, so the 33 minus the 25 gives us 8,000. All right. And with that, we have had our exposure to disposal of plant assets. Okay, natural resources. What we're talking about here, if you understand units of production depreciation, this closely parallels that. It's not depreciation, it's depletion, but the accounting is very similar to units of production depreciation. All right. What we're talking about is the mining of natural gas, oil, coal, ore, and things of that nature. All right. So here we see the basic formula, and if it looks like units of activity depreciation, That's because it's basically the same approach. Um, Total cost minus salvage value, which generally would relate to a parcel of land that a mining company has purchased, and then the total estimated units of ore or whatever mineral is being mined in the land, and you get depletion cost per unit. All right, and then as units are mined with ore, you multiply times the cost per unit times the number extracted and sold, and you get depletion expense. That's how that works. Let's take a look at it in action. Okay, so now we're going to look at E911, applying depletion of natural resources. Again on page 463. And the requirements are the instructions: prepare the journal entry to report depletion expense. Assume that 100,000 tons of ore were mined, and this is part B. Assume that 100,000 tons of ore were mined, only 80,000 were sold. How would the applicable cost of the 20,000 unsold units be reported? All right. So we'll work through part A and then kind of talk through part B. All right. On July 1st, Freedman Incorporated invested $720,000 in a mine estimated to have 900,000 tons of ore of uniform grade. During the last 6 months of 2015, 100,000 tons of ore were mined and sold. All right. Prepare the entry. All right. So the first step is the computation of depletion per unit of ore, in this case, ton of ore mined. So that's going to be 720 over the 900,000 tons. Which works out to 80 cents per ton. 80 cents of depletion per ton. So with that, our journal entry, we can go ahead and book that. It is depletion expense, which is not depreciation, but depletion, and accumulated depletion. All right. All right. So that formula is going to be 0.8 times the 100. We'll do 0.80 times the 100,000 tons that were mined. All right. All right. And that's what they asked for. That is depletion. Part B asked for assume only 20,000 were sold. So I'm sorry, assume 20,000 remain unsold. All right. Well, in that case, the 20,000 unsold units are an inventory item at 80 cents per ton. All right. And the entry in Part B is only 80,000 of the 100,000 units mined was sold. It basically is the same entry with a different number. All right. And then the other 16,000 is an inventory asset, or waiting to be sold. All right. That's your basic accounting for depletion. Okay. Our last talking point, coming down the home stretch here, intangible assets. So what we're going to talk about is, well, let's start before we get into what types of intangibles we're going to talk about. What is an intangible? So it's the opposite of everything we've talked about up to this point. And a tangible asset is something you can touch and see and feel. Intangible assets represent rights, privileges, basically the right to protect the process, the right to do something, or the right to preclude other individuals from doing something that results in a competitive advantage. All right, so we'll talk about patents, copyrights, goodwill, trademarks, franchises. All right. Before we get into the nuts and bolts of the type of intangibles, we need to separate them into two categories: limited life and unlimited or indefinite life. So our limited life intangibles, we amortize. Basically, if you understand straight line depreciation, you will understand amortization. The only difference is that there's no accumulated amortization account. You just credit the asset account. All right. Indefinite life intangibles, you don't have to amortize. All right. They would periodically be checked for impairment, but again, that's outside the scope of this course. All right. Patents. Patents are registered with the U.S. Patent and Trade Office. Can last up to 20 years, and they're amortized over either 20 years or useful life, whichever is shorter. So you think of like a technology patent that may be useful for 3 years because technology moves faster, so in probably 3 years somebody will patent something better. All right, in that case, you amortize that technology patent over 3 years. All right. Research and development and getting to a patentable process is always an expense. So the costs that we see in the patent expense all relate to legal costs in registering the patent and defense of a patent. All right. Copyright. Any creative work can be copywritten. Creative work made by individuals like you and me lasts for your lifetime plus 70 years. Creative work made by a corporation, i.e. an employee of the corporation, lasts 120 years. Right? And they're amortized over the estimated useful life, not necessarily the full life of the creator plus 70 years, but the time period in which it will be marketable. Right? Trademarks and trade names, we don't amortize because they have an indefinite life. As long as you renew trademark, that is, pay your registration fee with the U.S. Trademark Office every 20 years, you can protect your trade name forever. All right, so Coca-Cola, think Nike Swoosh, think the Keebler L, those types of things can be protected indefinitely. All right. Franchises, and this is kind of the wild card. It could either be indefinite, but most franchises do have a limited life. And for those that do, you amortize them over its limited useful life. Right? Franchises are like buying into a business. So if I set up a Subway, I have paid for a franchise agreement. Goodwill is only created when a one company purchases another for an amount exceeding the fair market value of the asset. In that case, goodwill would be recorded as the difference between the price paid and then the fair value of the net asset. Will not be amortized, but it is checked periodically for impairment. And research development costs, we can make very short work of this. Research and development expenditures that lead to any intangible asset are expensive. Alright, so if you see that, they go straight to the income statement. Alright. Alright, so the last thing we're going to do today is E9-13. And this is applying what we just talked about with intangibles. Alright? Okay. So the instructions begin on page 463. Prepare the necessary entries to record these intangibles. All costs incurred were for cash. Make the adjusting entries as of December 31st, 2016, recording any necessary amortization and reflecting all balances accurately as of that date. Okay. So let's start through. Gill Company, organized in 2015, has the following transactions related to intangible assets. Okay, so let's start with the January 2nd purchase. Purchase patent with a 7-year life. So we debit the patent, credit cash, total all transactions were for cash, $595,000. Alright, that's all we need to do there. 401-15, goodwill purchase, indefinite life. Goodwill, cash. Alright, $360,000. Moving along, 7-1-15, purchase a 10-year franchise. For cash, $480,000. Alright. And 9-1-15. Alright. Research and development. Alright. So as each one of these is an intangible asset that ends up on the asset section of the balance sheet, research and development we know we can make short work of because it's always going to be an expense. Straight to the balance sheet. The reason for that is because not all research, in fact, in many industries, most research doesn't lead to patentable products or patentable processes. And there was $185,000 worth of research and development expense. Okay. So those are all the purchase of intangibles during the year. Lastly, we need to adjust for amortization. So we have a debit to amortization expense. And we need to figure out what accounts need amortization and what accounts don't. Keep in mind, indefinite life assets do not amortize. Alright, so that's going to be goodwill. Goodwill has an indefinite life. R&D is an expense. So that's not even on the balance sheet. We wouldn't need to amortize that. Which leaves the franchise, which has a 10-year life, so that would be subject to amortization. And the patent, which has a 7-year life, also would be subject to amortization. One thing to keep in mind, we don't have an accumulated amortization account, so with intangibles, you just directly reduce the amount of the asset account. By how much? Well, for the patent, $595,000, it's a 7-year patent. All right, so $85,000 each year. For goodwill, it was a 10-year agreement. I'm sorry, not goodwill, for the franchise. 10-year agreement. Paid $480,000 for it, which works out to $48,000. Actually, no, it doesn't, because it was acquired in mid-year, so we need to take half a year, 6/12, because it was acquired in July 1. That's going to be 6.2, that should be 6. Divided by 2. Right, and so that's 24,000 on the franchise. All right, so those are the entries that actually, let's finish this one. Okay, so those are the entries that the problem asked for, and that's all the question really asked for, except for it also asked for necessary balances, the intangible balances. Well, the patent balance at the end of the year would be, would be the 595 less the 85,000, which gives you $510,000. So that would be the balance in the patent at year end. Goodwill's still going to be at 360. The franchise would be valued at 480, less the 24,000, giving you $456,000. And of course, the research and development would be expense. So that's how the balances would fall out at year end.